Exchange rates are prices that are determined by supply and demand. For some countries, the exchange rate is the single most important price in the economy because it determines the international balance of payment. There is no general theory of exchange rate determination, but Aitman et al. Divided the potential exchange rate determinants into 5 areas. First one, parity conditions, infrastructure, speculation, cross-border, foreign direct investment, and portfolio investment and political risk. Although no model has been consistent in predicting short-term foreign exchange rate behavior, there are several major concepts that play a role in determining the long-term behavior of foreign exchange rates. The first concept is based on the idea that the current price of an asset reflects all available information, and therefore only unexpected event causes exchange rates to fluctuate. What determines exchange rate in the short run? The first one, relative levels of interest rate. The level of nominal money interest rate is the first approximation of the rate of return on asset that can be earned in a particular country. Thus, difference in the level of nominal interest rate between economies are likely to affect the international investment flows, and investors take the highest rate of return. When interest rate in the United States are significantly higher than interest rate abroad, the foreign demand for U.S. security and bond accounts will increase, which increase the demand for dollar needed to buy assets, thus causing the dollar to appreciate relative to foreign currency. In contrast, if interest rate in the United States are on average low than interest rate abroad, the demand for foreign security and bank will decrease. To illustrate the effect of relative interest rate as a determinant of exchange rate, refer to figure 2.1. It shows the demand on supply sector for pound internationally. The equilibrium exchange rate is 1.5 per dollar per pound, referring to 2.1. Assume that expansion monetary policy of the US Federal result in a fall interest rate to 3%, while interest rate in the United Kingdom are at 6%. American investors will be attracted to the relative high interest rate in the United Kingdom, will demand more pounds to buy UK Treasury bill. The demand for pound does rise. D1 in the figuratively, the UK investor will find investing in the US less attractive than before, so fewer pounds will be offered to buy dollars. For purchase US security, the supply of pound does decrease to S1. The combined effect of these two shift this to cause the dollar to appreciate to $1.6 per pound. Alternative interest rate were lower to the United Kingdom. When the United States, the dollar will appreciate against the pound as America made fewer investment in the United Kingdom and UK. Investors made more investment in the United States. Things may not always be simple, although concerning the relation between interest rate, investment flows, and exchange rates, it is important to distinguish between the nominal interest rate and the real interest rate. Second one, expected change in the exchange rate. Different interest rate may not be all investors need to know guide their decision. They must also consider that the return actually realized for an investment is paid off of some future period. This time frame means in their realized value, the future payment can be altered by change in the exchange rate itself over the term of the investment. Simply put, investor must think about possible gain and losses of foreign currency transaction in addition to interest rate on asset. Expectation about the future paid of the exchange rate itself will figure out prominently in the investor calculation of what she or he will actually earn from investment dominated in another currency. Even a high interest rate will be attractive if one expects the denominating currency to depreciate at a similar or greater rate in its economic gain. What determines exchange rate in the long run? Factors in the long value of the exchange rate are due to reaction of traders in the foreign exchange market to change in 4 key determinants. First one, relative price level. Second, relative productivity levels. The third one, consumer preference for domestic and foreign goods. And does change in demand for export-import? The first one, price level. The domestic price level increased significantly in Singapore and remains constant in Malaysia. This causes Singapore consumer to desire relatively low price in Malaysia goods. The demand for ringgit will increase. Conversely, as the Malaysia will consume purchase less relatively high price Singapore good, the supply of ringgit will decrease. The increase in the demand for ringgit, the decrease in supply for ringgit result in depreciation to dollar, 2.9 per dollar. This analysis suggests that the increase in the Singapore price level relative to price level in the other country causes the dollar depreciation in the long run. According to Ong Kia, many Singaporeans might be showing great pleasure over the week of Malaysia ringgit because they can shopping trade neighbour Johor Fairway are now significantly cheap. However, a weak Malaysian economy is worse news for Singaporeans. As our largest study partner, they will demand more ringgit and will lead dollar to depreciation. Second one, productivity levels. Productivity growth measures the increase in a country output for given level of output. If one country able to produce more the output and become more productivity than other countries, it can produce goods cheaper than its foreign competitors can. Productivity gains are vital to the economy because they allow us to accomplish more with less. Capital and labor are both scarce resources, so maximizing their impact is always a core concern of modern business. Productivity enhancement came from technology advance such as computer and internet supply chain and logistic involvement and increased skill level within the workforce. Suppose Malaysia productivity grow faster than that of Singapore. As Malaysian goods become relatively less expensive, Singapore demands more Malaysia goods will result in increase in supply of dollar, which demand for forward Singapore good will become relatively more expensive causing the demand of dollar decrease. Therefore, the ringgit appreciation simply in the long run as a country become more productivity relative to other country currency appreciation. According to Minister of International Trade Industry Malaysia, Datuk Seri Mustafa Mohamed, Malaysia record productivity growth of 4.6% in tandem with the 5.1% gross domestic GDP growth and 6.6% increase in employment 2011. Third one, preference for domestic on foreign goods. Suppose that Singapore consumer develop stronger preference for Malaysia manufacturing goods such as foods and tourist attraction. The stronger demand for Malaysia goods result in Singaporean more ringgit to purchase the goods. As the demand for ringgit rises to dollar, depreciate to ringgit. Conversely, in Malaysia, consumer demand additional Singaporean commuter Singapore and the dollar will tend appreciate against the ringgit. We conclude that an increased demand for a country's export causes its currency to appreciate in the long run. Conversely, increased demand for import result in depreciation in the domestic currency. Fourth one, trade barriers. Barriers to free trade also affect exchange. Suppose that Malaysia government imposed a tariff on Singapore computer software. The tariff discouraged Malaysians from purchasing Singapore computer software. The tariff causes the demand for dollar to decrease, result in appreciation of the ringgit per dollar. As a result, trade barriers such as tariff and quota causes a currency pressure in the long run for the country imposing the trade barrier. Here are some graphs that you can see it.